might be asking, how does a Fibonacci sequence of EMAs point to the end of a trend? The answer is, the most efficient tools are trend-related, and using a Fibonacci sequence EMA filter is a great way to exit a position after a 5-wave sequence. Let's illustrate. You are now very familiar with a 5-wave sequence and understand which waves move with the trend, waves 1, 3, and 5, and which waves move counter-trend, waves 2 and 4. If you observe enough charts of varying time frames, especially the hourly and 15-minute, you will become familiar with the wave 1 start of the trend, the wave 3 impulsive thrust of the trend, and the wave 5 completeness of the trend, and of course the corrective pauses in between. This description holds true for every 5-wave sequence of every degree. In fact, taking apart trends will become intuitive after a while. One simple and efficient tool to use to analyze the end of trends is the 534.5 MACD or the Awesome Oscillator. A second simple and efficient tool which complements the MACD is using a combination of 8, 13, 21, and 34 period EMAs. Notice that these EMAs are part of the Fibonacci sequence, as are the moving averages in the MACD. The smallest EMA, the 8 period, is the most volatile and creates market whipsaws, as it hugs the price action very well, whereas the 34 period is the least volatile of this EMA series. Note some observations. When the 8 period EMA is pierced by a candle, it acts as a warning of a hesitation in the trend if the candle pierces but stays below the 8 period EMA. The trend will continue if the close is below all 4 EMAs, but if the close is above the 21 and the 34 period EMA, it's a signal that an eventual pullback or reversal may be imminent. At this point, the 8 period EMA will cross above the other averages and you will see convergence and crossover. This is exactly the time to exit a position, signaling the end of a 5-wave move. If, however, this crossover occurs at the end of a wave 3, it might also be time to exit in the case of a prolonged wave 4 correction. Another observation is how the price action hugs the moving averages. Notice that at the end of the wave 1, 3, and 5, the price action moves away from the averages in an impulsive frenzy. This is traders' emotional desires to stay with the trend, even if there are signs of a completion of the trend. What you see next is that the price action always comes back to the averages. There is little value in entering a position at this stage of the game, as the price will revert to the mean a few price bars later. Another observation is that when price comes back to the average without piercing it, this indicates that another move in the direction of the trend is pending. These consolidations may be considered to be the real catalysts of a trend's strength. As long as they continue, the current impulsive wave is not complete, even though it may seem extended at a certain stage. These hugs or resting points are important factors in determining a trend's strength. They are necessary halts in a trend which add to the trend's momentum. Let's take our example and have a look at the subwave 3 of this 5-wave sequence and see how the price action trades with the combination of EMAs. I call the tool the 8, 13, 21, and 34-day Fibonacci EMA filter. Starting at the beginning of wave 1, the Fibonacci filter gets us into our first short position when the 8-day EMA crosses all 3 EMAs. We don't get in at the top, but we get in on the 4th down candle. A less conservative entry would be on the cross of the 8 and 13-day moving averages, as that would get us in on the 3rd down candle. If we took 3 lots, we would ride the lots through the end of wave 1. We would exit the first lot when the 8-day crosses above the 13-day EMA. We would exit the second lot when the 8-day crosses above the 21-day EMA. Since the 8-day doesn't cross above the 34-day EMA, we would still be holding on to one lot. Knowing what we know about the wave counts, we see that we have exited the positions on a wave 2 correction. We look to reestablish the sells when the 8-day moving average crosses back below the 21-day and 13-day averages. We are now short 3 lots again. We ride the move all the way down through the completion of the 5-wave sequence, and we exit all 3 lots as the 8-period moving average crosses back over the 13, 21, and 34-day EMAs. This was a successful trade. The Fibonacci EMA filter keeps us in the trade practically the entire down move. Notice how the prices hug the 8-day EMA. Notice also that when we move away from the 8-day EMA, as in the end of the 5-wave sequence, the law of averages brings us back to the EMAs like a magnet. Knowing that it is a 5-wave sequence, we could decide to exit the trade prior to getting stopped out. This is where we would draw our channels and target the end of wave 5 using the Fibonacci projections. We would also look to see confirmation that there is divergence in the oscillator. This example looks at the subwave 5 of the 5-wave sequence, and we go through the same exercise. We sell 3 lots when the 8-day EMA crosses over the other 3 EMAs, and we enter short on the 8th candle from the top of the sequence. Entering on the cross of the 8 and the 13 EMA would get us short on the 5th candle. We stay short through wave 4, where we exit 1 out of the 3 lots as soon as the 8-day crosses back over the 13-day EMA. We reestablish our short 6 candles later when we see the cross with separation. We stay short until the end of wave 5, and we exit all 3 lots at 3 different levels as the 8-day EMA crosses over the 13, 21, and 34-day EMAs. Again, when this is used in combination with the other tools, we are able to pinpoint the end of a trend so that we can call the start of the new trend. The last tool we are going to take a look at is Japanese candlestick reversal patterns. The Japanese have used candlesticks as a charting and analysis technique for centuries, but only in recent years has it become popular in the West. A Japanese candle pattern is a psychological manifestation of what traders at large are thinking at any given time. They form both continuation and reversal patterns, just like with chart pattern analysis. Whenever a reversal pattern is bullish, an inversely related pattern is bearish. When there is a pair of patterns that work in both bullish and bearish situations, they usually have the same name. In a few cases, however, the bullish reversal pattern with its bearish reversal counterpart have completely different names. Bearish reversal patterns form in an uptrend at a price peak. Bullish reversal patterns form in a downtrend at a price low. A few reversal patterns include the piercing line. This pattern has bullish implications as the downtrend is intact on day 1, but reverses on day 2 from an opening level lower than the previous day's close. The bullish engulfing pattern. With this pattern, day 1 is in a downtrend with a small body. Day 2 reverses, where the body completely engulfs the previous day's body. A few bearish reversal patterns. The dark cloud cover. This is a 2-day reversal pattern that has bearish implications. Its counterpart is called the piercing line. The first candle has a long blue body, confirming the uptrend. The second candle opens above the high price of the previous day, adding to the bullishness. However, during the day, the sellers emerge and a red body forms, with the closing price at least below the midpoint of the first candle. This will force traders to exit the long positions as there is no follow-through. And finally, the bearish engulfing pattern. The first day is characterized by a small body in an uptrend, followed by a day whose body completely engulfs the previous day's body. Here are a few more of the bullish and bearish reversal patterns as a confirmation for the end of a trend. Please note that there are approximately 40 reversal candle patterns, which vary from single candlesticks to groupings of up to 5 candlesticks. Also, candlestick patterns are best used with other confirmation signals, such as oscillator divergence and reversal chart patterns. This concludes this section on determining the end of a trend. You now have a complete toolkit of trend-ending indicators and reversal patterns that will take you a long way compared to other traders. To summarize, there are several methods of determining the end of a trend. They include 1. Channeling to target wave 5. 2. Projected price in the target zone for 5-wave sequence and internal subwave 5. 3. Divergence between waves 3 and 5 and a change in direction of the current momentum. 4. Reversal chart patterns, including rising or falling wedges, broken trend lines, double tops or triple tops and bottoms, a 1, 2, 3 top or bottom. And 5. The 8, 13, 21, and 34-day Fibonacci EMA filter. And finally, 6. Candlestick reversal patterns. This is the end of the learning object. Please continue on to the quiz.